Welcome to the ML Tax course by Margervas, and today we are going to be talking about one of the biggest judgment in the Indian tax history since the biggest since Vodafone, and one of the biggest one, and comparable to the impact of this to what happened in the Vodafone case law. We're going to be talking about the Supreme Court judgment in case of Tiger Global. So let's understand what was the facts of the case. So Tiger Global had three funds: Tiger Global 2, 3, and 4, set up in Mauritius, which hold shares in Flipkart Singapore company and which hold shares in Flipkart India company. And this Flipkart Singapore company derived value substantially from assets located in India. So this was an indirect transfer. They transferred. So when if Flipkart Singapore was transferred, it would be an indirect transfer. Now we all remember in 2018, Walmart acquired Flipkart from various shareholders. Walmart acquired 74% of Flipkart, and Tiger Global was one of the shareholders who sold its shares in Flipkart, and that they sold the shares of the Singapore company. So it was a case of indirect transfer. And as we discussed in one of the previous videos in the course, that under the India Mauritius Treaty or under other treaties, but India Mauritius specifically, indirect transfers was still exempt even after 1st April 2017. Plus, in this case, the investment was made before 1st April 2017. And accordingly, Tiger Global Mauritius claimed that no tax should arise on this transfer. So these are the facts reiterated. And after the sale was done in 2018, Tiger Global applied to AAR, first applied to tax authorities for nil withholding certificate, which was rejected, and they were asked by the tax authorities to that there should be withholding of on for all the three funds. Against this, they filed an appeal to they approached the AAR seeking an advance ruling, and we will go into detail of the AAR ruling, but AAR rejected their approach, saying that they were set up prima facie for the avoidance of to take benefit of tax treaty to and avoid taxation. In against that order of AAR, Tiger Global filed the High Court writ petition in High Court, which was allowed, and the High Court said that this transaction should not be taxable in India, and against which the revenue filed appeal in the Supreme Court. Now, what happened in the AAR? So the AAR concluded that the real control of Tiger Global Mauritius, the three funds that we discussed, Tiger Global 2, 3, and 4, was not in Mauritius, but with Mr. Charles P. Coleman, who was not a resident of Mauritius, and accordingly, the brain of Tiger Global was not in Mauritius. Secondly, the AAR argued that the exemption that we discussed of grandfathering of investment, that was any investment made prior to 1st April 2017 in the from Mauritius. If we go to the treaty, so if you look 3A shares, if you look at on yeah, so if 3A provides for taxes on shares acquired on or after 1st April 2017 will be taxed in the state in which the company is resident. So any investment before 1st April 17 would not be taxable in India. So AAR in its ruling said that the shares were sold but not of an Indian company. So there was no investment made into India, and so there should be no benefit of the grandfathering clause. And there is a circular by CBDT, circular number 682, which argued about that Mauritius residents will not be taxed in India if for their investments in Indian company if they're not residents of India also. And they said that this would not be applicable because the shares transferred were not of Indian companies. And based on all of this, the AAR concluded that further the AAR also concluded that the agreement was structured or the arrangement structured in such a way that to take advantage of the DTAA, and there was no commercial substance of Tiger Global to be set up in Mauritius. Against this order, Tiger Global filed appeal in the High Court. Now, the High Court found that AAR or the tax authorities were not able to succeed in rebuting that TGM LLC. So TGM LLC is basically the fund advisor entity which provided advisory services to the three Tiger Global funds which hold shares in the Flipkart Singapore company. So the High Court held that they did not provide any substance or any uh, proof that the TGM LLC had any shares in those three funds and was just an advisor. The, Further, the High Court stated in its order that the three funds were structured in a way as pooling vehicles to raise investment from 500 investors from 30 jurisdictions, and this strategy was prudent in terms of High Court because it allowed efficiency so that those 500 investors didn't have to directly invest into the Flipkart Singapore and then on exit Walmart didn't have to go and find each one of them. They can do that through these three funds. And again, High Court also found that the Tiger Global being not having any substance in Mauritius as baseless. They relied on the judgment of Vodafone and Azadi Bajao of Supreme Court and held that Mauritius is an accepted route for foreign investment. I've made a video on the Vodafone judgment as well. So basically, the argument in that order of the Supreme Court was that a structure cannot be said to be illegal just because there is tax efficiency in it. And investment through Mauritius has been accepted by the government to be an acceptable route of investment for foreign investment. And accordingly, High Court held that to challenge treaty benefits when there is a LOB clause in the treaty requires a higher threshold, much more than just the much more than just that they did not have enough substance. And lastly, the High Court found that AAR's interpretation of 13A, 3A was unsound because because the Singapore company was deriving value complete from the shares located in India. So the High Court argued that in this case also this was the shares which were acquired prior to 1st April 17 of a company resident in India, and accordingly the benefit of grandfathering under Mauritius Treaty should be given to Tiger Global Funds. And accordingly they dismissed the order of AAR and said that this transaction would not be taxable in India. Against this, the revenue filed appeal in the Supreme Court. Now we come to the Supreme Court ruling. So the Supreme Court ruling is a 152-page ruling which goes into 5 major parts about it. It talks about whether this transaction would have been taxable in India. It talks about the sufficiency of TRC for claiming treaty benefit. Then it talks about general anti-avoidance rules and judicial anti-avoidance rules. And it talks about residency under DTAA and tax benefits under DTAA. And finally, it talks about the sovereignty of India for taxation of these global structures. So we'll just need to pause and look into the treaty and where this whole matter comes. So if you focus on Article 3A and 3B of this treaty and then Article 4, you will find the matter. So as we discussed in the previous video, Mauritius provides benefit up until 31st March 2017 that any investment in shares which was not having an immovable property in India or was not linked to a permanent establishment in India would be taxed in Mauritius if the person who has made that investment is a resident of Mauritius. However, if the investment was made after 1st April 17, then that would be taxable in India. But now the important section, the important paragraph is the fourth one, which is the third para applies only for the shares of a company which is resident in India. But if the company is not resident in India, which is in this case Flipkart Singapore, whose shares were sold, was not a resident in India, and so the Article 3A or 3B should not apply, and Article 4 should apply, and accordingly should be taxed in the state in which the alienator is resident. So why the Supreme Court did not allow this, we will go into detail about it. So the main crux of this ruling is on the legislative history of the DTAA between India and Mauritius, the Vodafone case law, and then the subsequent amendments after that by the government, and the introduction of GAR in the Income Tax Act. Supreme Court in its ruling noted that this transaction would not be taxable in the Mauritius domestic law as well, creating an arbitrage possibility which has existed in the treaty and the domestic law of Mauritius for a long time, and which was curbed by India in 2016 by amending the DTAA. Then the Supreme Court goes into deep about the history of the Mauritius DTAA, the various civil circulars on this treaty, which include the Circular 682 that we discussed earlier, and the big one, the Circular 789, which was also discussed in both Azadi Bajao Andolan and the Vodafone case. And then the Supreme Court goes into detail in the Vodafone and the Azadi Bachao rulings that it had passed. And post the Vodafone ruling, the amendments made in the Finance Bill 2012 and then the amendments to DTAA and the introduction of GAR provisions. The Supreme Court, based on all of those detailed historical analysis, stated that up until 2016, before the amendment to DTAA, Mauritius India Treaty provided taxation based on residence for investment in shares. However, India specifically brought in the rule to tax based on the source, which is wherever the company derives the value will or the company is resident, and accordingly production was provided in the DTAA as we saw in Article 3A and 3B. And right along this time that India amended its DTAA, the Indian Income Tax Act was amended to introduce the provisions for GAR. The GAR provisions were in discussions for a long time and were pushed back from 2010 before being finally implemented in 2017. So while is treaty and the Supreme Court then further argues that treaty specifically provided grandfathering for investment made prior to 1st April 2017. And similar language is in there in GAR provisions that any sale which has happened before 1st April 2017 will not be considered for GAR provisions. However, the difference between treaty and GAR is that for treaty, if the investment was made before 1st April 2017, it is gets grandfathering benefit. But for GAR provisions, even if the investment was made before 2017, but if the sale happens after 1st April 2017, and if the arrangement through which the sale happens is found to be an avoidance measure to take advantage of tax treaties, then GAR provisions can still apply. And this difference is the main point of this judgment. That is, even if the investment was made prior to 1st April 2017, if it lacks commercial substance for the investment or for the sale or both, then still GAR provisions can apply. Now the second big question was the sufficiency of TRC. Up until now, TRC, especially for the Mauritius DTAA, was considered to be sacrosanct and considered to be enough for residency, especially based on the circular number 789 of the CBDT, which said that the TRC would be sufficient for the residency of Mauritius-based entities. And there was a consensus based on the Vodafone and the Azadi Bachao Andolan that the revenue authorities cannot go behind the TRC and lift the corporate lien. However, in this ruling, the Supreme Court had stated that those rulings in Azadi Bachao Andolan and Vodafone were made prior to the amendments to the Finance Bill 2012 and the amendments to the DTAA and introduction of GAR. Post these amendments, India moved from a residence-based taxation in these treaties to source-based taxation. And introduction of GAR provisions now allow the Indian tax authorities to inquire into the residency of the taxpayer. Thus, in this ruling, the Supreme Court has held that even if the taxpayer has a TRC, tax authorities can still lift a corporate lien and check whether they are actually legitimately resident of the country for which they are claiming the treaty. This is a massive shift because now the onus of proof to prove the residency increases from just a TRC for the taxpayers. Now the third point that they covered was the applicability of JAR. JAR is the Judicial Anti-Avoidance Rule. So there are three kinds of anti-avoidance rules. One is General Anti-Avoidance Rules, which is GAR, which is if the transaction lacks substance, if transaction is a round tripping or there is no commercial reason to do a transaction other than to take advantage, then you can invoke GAR provisions. The second is specific anti-avoidance provision rules, which are SAR. That is, for example, in the Income Tax Act, you have Rule Revenue Act 50C and 56 to 10, which says that any sale of unlisted shares of a company cannot take place before below the FMV, or 50C for land and building, which cannot land and building cannot be, if land and building is transferred below stamp duty value, then stamp duty value will be the transaction. So these provisions are known as SAR. And then judicial anti-avoidance rules, or JAR, are basically the power of the tax authorities or the judiciary to go into the transaction to say that if the transaction is just a conduit structure or a treaty abuse structure. And the Supreme Court said in this judgment that even if the GAR was not to be applicable, although they did not conclude that GAR was not applicable, even if, for example, in this transaction GAR would not have been applicable, if, for example, this sale would have happened before 1st April 17, then still the judicial anti-avoidance rules can have been applied to check if this transaction was structured for treaty abuse or if the entity was a conduit or a shell entity. And further, the Supreme Court noted that what strengthened the argument of the tax authorities was that the three funds of Tiger Global were not paying tax in the domestic laws of Mauritius, which meant that this would result in a double non-taxation. That is, there will be no tax in India and no tax in Mauritius. And finally, was the last part of this judgment was on the sovereignty of India for taxation. So after the full judgment is there, there is a full part by Justice J.B. Pardiwala that talks about the emphasizes on sovereignty of India for taxation rights, and he mentioned various points in his judgment about what India should do, and those things, those recommendations that is given in the judgment to the government will alter the way private equity funds or other foreign investors, if the government accepts those proposals, see investment in India. So what are some of his suggestions or recommendations? First of all, he emphasizes that the sovereignty of an tax sovereignty is an inherent and independent power of a nation that must be ensured to preserve the economic stability of this country. Secondly, it is the sovereign right of a nation to tax income generated on its own soil. So if you look in this transaction, the Flipkart Singapore entity derived value substantially from assets located in India, and according to Supreme Court, it is inherent right of India to tax income arising from that asset. Then it argues that for a nation to go with a long-term vision, it must maintain economic independence and ensure that external nations or multinational entities do not indicate or interfere with domestic tax policies choices. And in this, there was a detail in the main judgment and also in Justice J.B. Pardiwala's note that talks about that when India entered into the DTAA with Mauritius, at that time in 90s and 2000, the idea was to attract foreign investment, and India was in a different stage in comparison to now. And they made various examples where developing countries have to give up some concessions to attract foreign investments into their country, and which sometimes they allow for the tax benefits or tax avoidance strategies to be given up for the developed countries investors to invest into their country. However, as the times change, the countries must change their policies and change their vision accordingly. And and this is one of their 3 or 4 major recommendations. If you go towards the end of this judgment, includes that India should renegotiate the treaties where they've provided exemptions. India should not provide tax exemptions, rather they should provide for foreign tax credit. There should be a limitation of benefit clause in all the tax treaties. So these recommendations basically say that India should no longer allow for residence-based taxation and should go for source-based taxation. And in the last, they've emphasized multiple times in the main judgment and in Justice J.B. Pardiwala's note that the there should be impeccable strength from India to allow to stand up to the cross-border tax evasion, multi money laundering, and round-tripping of funds. And that is why they have emphasized multiple times that India should focus on source-based taxation. And so, eventually, what was the conclusion that the Supreme Court gave in their judgment? The main reason why Tiger Global was denied treaty benefit and was said to be taxable in India was that the three funds, Tiger Global 2, 3, and 4, lacked substance in Mauritius and were set up to take advantage of the treaty benefit, and accordingly they would be required to pay tax in India. And what this judgment is there are three major conclusions from this judgment. The first one is that TRC is no longer sufficient for residency. Now you need more than just TRC to satisfy that you are a resident. In this case, Tiger Global had two of their three directors were Mauritius residents. They had a bank account in Mauritius, yet they were not able to substantiate that they have enough substance in the Mauritius. So basically, what Supreme Court is trying to emphasize that any taxpayer that is trying to claim benefit under the treaty must actually have some commercial activities in the country which it is trying to claim to be a resident. Secondly, that now our provisions will become a bigger factor, especially for the transactions where the investment happened prior to 1st April 17 and still happen after 1st April 17. And this is also in a bigger judgment because a lot of structures we have in the private equity and the other structures also, and there are other cross-border structures as well where these are structured with a holding company outside India in Singapore or Mauritius specifically, which provided this benefit. But now with these GAR provisions being applicable and a higher scrutiny on TRs, on residency and GAR, they will have to reevaluate those structures. And these recommendations by the Supreme Court to relook the DTAAS and preserve source-based taxation and provide GAR overrides in treaty along with the lobby clause. Just before the budget, we are on 17 January today. The judgment came on 15 January and the budget is to come on 1st February. So within 15-16 days before the budget. And if you look at the ruling in case of Nestle SA on the MFN clause, if you tie all of this together, this is increases the anticipation of the budget, whether there are going to be any significant changes or significant updates from the government on the budget based on the recommendation of the Supreme Court or as a reaction to this judgment. So let me know what you think about this ruling. How big of an impact do you think this will have, and what are your views of this ruling? And thanks for watching.